we will do some brief introductions individually of all the other panelists, and then we'll move on to our discussion. Haroldo.
Thank you. Thank you, Marc. Thank you all. It's good to be here with you all. Haroldo Andrade, I work for Unimetal. I came from oil and gas industry. I trade basically all kind of products you can imagine, from petrochemical, biofuels, paraffin waxes, sulfur, urea. And the last 4 years, I work for on the metal side. So I supply, my company that I work for, Unimetal, is one of the global main suppliers for the aluminum, steel, iron industries, and we also supply battery material producers.
Hello, everyone. Hello, Marc. Thanks so much for the invitation to be here today. Happy to be sitting on this panel. I'm Daniele Porta. I'm Gerald Group's Global Head for Sustainability and ESG. I'm a geologist by training, so I've been in the mining and metals sector all my career. Previously to joining Gerald, where I've been for the past 3 years, I was with the World Bank for almost 20 years. And at the bank, I was leading the Climate Smart Mining Initiative, which was an initiative that looked at the role of minerals and metals for the energy transition and looked at supply chain integrity and how do we improve sustainability in these mineral supply chains.
Good morning. Thank you all for joining us. Thank you, Marc, and Commodities people for inviting us. So my name is Lance Fogtman. I am in strategy at Ion Commodities. Ion is part of a global fintech solution, so we pretty much drive the majority of the trading and risk solutions for all commodities. I personally have been with Ion for 19 years now, but I started my career, same as you, Haroldo, basically with Shell, so an old oil and gas mostly guy, mostly the oil side from the middle 90s, and 3 decades of, simply put, delivering technology and commodity solutions, and Ion's the largest provider of that. So I drive the strategy for bulk commodities, so that would be, in simple terms, anything you can put on a boat. Very good to be here.
So you can see we've got a very diverse panel. We'll be able to offer some insights both on actual flows, on the key aspects of ESG and sustainability and the pressures thereon, and obviously data and technology. So some very different aspects to this, all areas which are very important both to the metals and mining outlook, and indeed to considering how all of this affects supply chain security. I've got a very deliberately broad first question, which each of the panelists will address more from their own perspective rather than looking at necessarily just specifically price trends. What do you see as the key impacts of tariffs, of all the geopolitical tensions, turmoil that we have on the metals and mining supply sectors? Above all, in terms of how can we preserve supply chain security within that? Haroldo, perhaps you'd like to kick us off.
Well, it's a very interesting point. What we see now is something that we predict that will happen. We see volatility, we see uncertainty, we see complexity, and we see ambiguity. In fact, as a trader, volatility is what we have for breakfast, right? So what we enjoy. So it's those complexity, those changes bring us some risks, some threats, and some very interesting opportunities. When I talk about risk, it's important to consider the probability and the impacts. So from the metal side, that's what I'm basically focused now. it's important to understand as one of the main suppliers for the aluminum, steel, and metal casting industry, including foundries, companies in the US like Caterpillar, John Deere, US Steel, Gerdau, ArcelorMittal, and Alcoa. Yesterday I was in Montreal with Rio Tinto, and next week I'll be in Spain with Alcoa. So we interact frequently in the market and discussing that. So when we talk about metals, it's important to observe that is a direct correlation with energy. Metals are essential to overcome this or to pass through this energy transition. We need metals to produce windmills, solar panels, EVs. Basically, you take a EV, basically the body is aluminum. We need metals to produce the chassis. So my company, we basically produce carbon products, so that we call the carbon paradox. To move to a world with a less carbon footprint, we need carbon. We need metals. And there is a paradox because we need energy to produce metals and we need metals to this energy transition. So what I'm seeing now is those volatility. They are bringing some definite changes in the market that we have the opportunity to discuss during this panel.
Thanks, Haroldo. And maybe just to complement, I think that even before tariffs in the Trump administration, we had been seeing a shift in terms of these global metal supply chains. There was a movement, you know, in Europe and even here in the US to move away from the dominance of China and in other countries, right? It was very much already starting to brew, and I think the tariffs just came to put more pressure and make it even more urgent. And this has resulted, as Haroldo was talking about, price volatilities, you know, issues on disruption of supply chains, which has then increased cost of these materials, of these raw materials to the industry. So it's really a big disruptor, right? And the pressure is to do more, you know, and faster. So, and that has a myriad of consequences. And for the first one that I think I would like to put out there is that we need to understand the both sides of the coin when it comes to tariffs, the short-term pressures and the instabilities that brings. But some would argue that in the long term, there is a strategic need for that, right? Which is the onshoring of these industries, be it the mining, be it the processing, you know, the refining of these materials. However, in the short term, it's really putting a lot of pressure on the industry. And one of the things, the OECD just did a really interesting paper the other day looking at what that meant for the OECD countries in terms of these disruptions. What did that mean? And it showed that for trade, it could reduce the trade volumes for these countries in 18% even, which is quite a significant, and also could also impact GDP of these countries, of these OECD countries, in up to 12%, which is massive if you think about GDP for OECD countries. So it's really a big pressure. And to talk about the ESG side of things, it's also putting a pressure on the ESG because ESG and sustainability is seen as a bottleneck to moving things faster. So people are trying to streamline, you know, be it the permitting for new mines or be it the permitting for new processing facilities. And that is and the ESG is trying to, you know, keep the standards and making sure that this is not done in, that we're still doing things the right way. So it's a problem. And My answer to that is that people need to stop thinking about sustainability and ESG as a tick the box and as a reporting exercise. ESG is about adding value. It's about value generation for all stakeholders in the supply chain. And when I talk about stakeholders, I'm talking about companies, I'm talking about shareholders, I'm talking about communities, I'm talking about the environment. The environment is an important stakeholder. So efficiency is sustainability. And that's what we need to focus on. More value, less reporting.
I was just about to ask you about efficiency, but you've already stolen
Yes.
that. Nice.
Yeah, thank you. That's excellent. Yes. So look, I think the way to answer this is to think about the short term and the longer term impact of tariffs and some of the recent events. So short term, you'll probably get no shortage of and intended there of advice and views on this. But Trump quickly learned that 50 bips against what is 36, 37 trillion, whatever, has a pretty material impact, and that wins versus his desire. So capital markets hitting pretty hard there. So short term, that and overall I think there generally is a desire to basically get deals done. But you're right, we definitely see, and some of our customers are starting to change their strategy, changing up some of their trade desks and so forth to configure towards more local flows. So that's definitely a nearby. Volatility is the clear, obvious answer, and it's great. And now we're seeing some volatility on the liquid side with some of the Middle East, so on. That particular event, I mean, I can only think of one customer that affects, a big aluminum smelter in Bahrain, right, that will have a little bit of difficulty as if some problems happen there, right? You'll know them. But the point being, short-term volatility, some sensible regression of the tariffs or, basically coming regression back to the mean. I think the mean is going to move, right? So when we say regression back to the mean, there's a trend up, right? So long term is a bit more interesting. From a sustainability side, we see specifically with our customers and technology-wise, that's adding some pretty interesting complexity. And it's not just a tick-the-box reporting exercise because they are going to have to understand the economic impact. Similarly, I mean, if you think about even short-term, I think about like CBAM adjustment and putting that into how you mark your trade flows or your trades, right? Similarly, what you do with, any kind of green metals or any kind of adjustment there in how you would mark or value your actual products, as well as more of the long-term impact or short-term impact, I apologize, on some of the contracts that we're seeing now have tariff provisions in them. So these are some of the interesting things which, from a technology perspective, makes it a little bit more difficult, right? Some technologies are flexible, some are not. Some processes and organizations are flexible, some are not, right? Some of the firms that are very flexible, that can move, that can adapt, that also have the technology to be able to do so, to be able to handle the volatility and the changes in trade flow, changes in contracts, changes, and all of these things that we need to capture are going to be the ones to succeed. And that's both in the short term and the long term.
The one observation on that would also be that we've been through so many shocks in the past 5 years that anyone who's modeling this, whether it's a sophisticated data model and you're trying to solve, your problem is you've got so many outliers in there that actually what's happened as a result of those attacks on Friday and the continuing tensions is market reaction has been, well, it's almost meh. And so we're starting to see price evolutions, particularly I think in oil, which to particularly older people like myself who've been in the markets like, why haven't we seen a $15, $20, $30 move in oil? And the answer is, well, it's not what it not what it was, simply because we've become, we've been so. My original degree is in psychology, and one of the favorite experiments in psychology is the reduced reaction physical reaction you see to continued shocks, small electrical shocks, and that's the sort of process we're going through at the moment. Be that as it may, let's move on. We've talked to sort of the top level impact. You're directly involved. What sort of actual shifts? Where are there significant shifts that you're seeing in terms of actual flows, and not only in terms of the actual flows of physical materials or intermediate or final materials, but also in terms of the financing, because we tend to sort of go, oh well, the flows are doing this, but somewhere along the line, someone's going to actually have to finance that.
That's a very interesting question, Marc. Thank you. Well, let's split my answer in two parts: physical flows and finance flows. Physical flows. It's clear there is a dramatic change in some commodity trade flows. The demand, Chinese demand, is weaker for several different materials, so that weakness impact either in prices or in the search for different new markets. Okay, month ago, 2 months ago, I received offers from stressed cargoes in the U.S. West Coast that support vessels fully loaded that's supposed to go to China, and tradings are offering me the cargo, the vessels, with fully loaded, paying the vessels and as daily basis, and they have no buy, no destinations. So definitely this new order is resulting in search for new physical commodity trade flows. That will happen. The best remedy for low prices are low prices. The best remedy for higher prices are higher prices, commodity higher prices. So I believe the market will adapt, but definitely changes, dramatic changes will happen. First, finance sides. It's clear that some changes are happening now. China is withdrawing a lot of investments that doing in the U.S., and that's reducing government the interest for government bonds, are changing the rates. There are some Howard mentioned his first presentation, the first panel, about the black fleet, vessel black fleet, but there's also, especially in the Middle East, there's a new market for the finance trading. I usually, when I trade products, we use SWIFTs. We sell based on US dollars, we buy based on US dollars, but it's clear there's a growing finance alternative market. So it's something that we are not directly involved in yet, but it's clear something that is going on. So important. I believe 1 year ago, I was in one of those panels discussing the strength of US dollars as a global currency for US trade. I do believe that the importance will not disappear tomorrow, but definitely other alternatives are being offered in the market. So it's important to pay attention on that.
That's a positive in many ways, that this is forcing alternatives where people have become very complacent about, well, we'll just finance it in dollars, and yeah, anything else not interesting. Not really because of anything other than dollars are familiar. It's sort of, we all want to have a quiet life. We don't need anything which, particularly given the experience of the past 5 years. Sorry, on to you, Daniele.
That's a good point.
Yeah.
Well, in terms of, I agree with Haroldo in terms of the new trade flows and how that's being reshaped completely, and new markets that are emerging. But I think that one important thing to note, and of course I'm not the expert here among the panelists on this topic, but it's also the higher cost of capital, which is also forcing companies to look elsewhere in terms of their financing needs. And commodity traders are, I think the new kids on the block. Not that commodity traders haven't been financing, but their importance in terms of financing new projects is becoming more preeminent because they're willing to take on more of the risk. And also because we're seeing more verticalized supply chains from mining to processing, and that also creates a different flows and different ways of financing these materials to markets.
Just sort of following up with some of your initial observations. Do you think it's going to harm efficiency drives in the short term, but ultimately be better? I'm not prejudging either.
I think that in some cases it will be more efficient, yes, because you have more control, right? But the efficiencies will only come if we, if we understand where the vulnerabilities are and how can we, manage those inefficiencies, and how can we partner with others to mitigate those inefficiencies. Because it may, if we leave it up to the markets, it's not going to happen, right? So we need to be proactive in managing those inefficiencies and making sure that we're mitigating them. Yes?
You brought a very interesting point that intrigued me. As it's important to observe that as we, and along of the years, we improve trade flow efficiency, somehow that trade efficiency increase the risks, because companies, they learn how to work with low inventory, and that's a process that happened along of the years. But now, recently, we have dramatic changes that disturb the market. So those disturbances, suddenly and abrupt disturbances, they brought a lot of uncertainties in the market. So they increase the risk because of that. So I'm sorry, that's a point that I really enjoy.
Hans.
Yeah, so I agree. U.S. dollar hegemony is not necessarily a great thing. And we are extremely active in the Middle East, and have seen actually a lot of, they're very concerned. They're less concerned about energy security because it's a hub for energy, as this, Texas wouldn't generally be concerned, right? Similarly, but they're very concerned about other types of commodities, specifically food supply, food security. So we've seen substantial change there, and we have seen the change in dirham and other currency-based financing, as well as, all you have to do is go to the ADGM, or the global markets area of Abu Dhabi, and you can just wander around and see what's going on. So a lot of that. So a lot of the financing of Africa is also moving into that region, whereas it formerly was either directly out of China, Singapore, or the U.S. and so on. So we are seeing that. What we're also seeing is complexity in the trade finance flow, is verticality, the sustainability pieces of that, because your notes and so forth have certain different types of covenants for sustainability in that to achieve certain discount factors, if you will. Mercuria just closed one a couple days ago, pretty large one with some items in there on their metals and sustainability implied in there. So we're seeing that increase in what we deem from an ION perspective. We look cross-trade finance, metals is the hardest area to finance because not just the verticality, but just the banks have just deeper and stronger covenants than some of the other commodity classes, if you will. So it's definitely a troublesome. Trade flows, not much to add there. Definite moves. Nearby, we've seen buildups of inventory, buildups of open interest position and long-term contracts due to making some bets on some different things will happen, whether it's tariff releases or regression of tariffs or closure of a Putin accord or something of that nature.
I'm going to follow up with a question I asked you in London. We were talking about nearshoring or onshoring. Realistically, here in the United States, how much of that can really be done?
Not much. I mean, we've seen a few projects, especially the quote critical minerals. I mean, the U.S. it's like 190 or 200 million of import. That's a couple cargoes of oil. That's nothing. I mean, that's right. So we can find it, and even if there is some kind of price spike, on the mineral side, critical minerals, rare earth, whatever, however you want to call that. I don't see that. I mean, the price gets high enough, you're going to get entrepreneurs and you're going to get engineers to figure out one of two ways. Entrepreneurs are going to figure out how to get that here cheaper than what it's selling at, or two, the engineers are going to figure out how to say, oh, well, we got too much lithium, we don't have enough lithium in this battery, this is the composition, let's figure out how to use less lithium in this battery. I mean, so it's just two kind of things that are going to happen, right? But no, I don't see substantial new products based off of what we're seeing, but we do see some. We're not seeing new. What we're seeing is them kind of take existing projects that had either been kind of not mothballed, but kind of been held over, but start to pick that up back.
If I may add a little bit to that as well, I think that for new projects, we are seeing some, but the problem is timing, right? We have, from exploration till you actually mine something, it can take 10, 12, 15 years. So the pressure is on, and we're not going to be delivering new projects anytime soon. So, and if you look at exploration, investments in exploration are actually falling because prices are not that exciting. If you look at lithium prices that have been depressed, even nickel because of the oversupply. So it's a challenge, is like you need new projects, but where is the incentive to actually finance these new, the exploration and let alone new projects? So the timing is an issue, and the incentive for financing these new projects. So it really, again, goes back to partnerships and partnering with countries that do have these resources more readily, more advanced in terms of project development.
Sure.
If I could add.
Yeah.
On top of that,
Yes.
we have been supplying battery material producers in the West. And on top of that, there's a technology volatility.
Absolutely.
So if you invest in mining, that will bring result in 10 years from now. And after that, those guys are discussing new technologies every day. So it's very risky to take positions on those.
And if I may add, it's really about criticality, right, of these critical minerals, how critical, and some are more critical than others because precisely they are very tied to some technology, and then the uncertainties are even higher, like cobalt and lithium. They're very tied to battery minerals, And battery minerals, as we know, there are many new technologies out there. None are, ready to be deployed in a commercial scale. And also in terms of performance, they're not as good. But there's a lot of research going on. What if there's a new battery chemistry technology out there that doesn't use lithium or doesn't use cobalt? So that provides a level of uncertainty that really scares the investors, right?
I think that's a very, very, very important point, that the development of a lot of particularly battery technology, but there's a whole slew of others,
Yes.
is still in its infancy. The science isn't stable. If the science isn't stable, the engineering can't be stable. And if the science and the engineering can't be stable, how can you develop a secondary market for people who are ultimately, the people you're supplying? How do they actually get round to, well, how can I secure a proper supply chain when I don't know what supplies I need? Because the scientists are telling me, yeah, but maybe in 3 months or 6 months or 12 months' time, we're going to have something even more super duper, and it'll probably be couched in terms which are, shall we say, Trumpian. I slightly exaggerated about exactly what they'll be achieving, and you have to then make value judgments. So, your type of customers, end users, people who are, going from the intermediate to the final good stage, how are they dealing with all of this? Because, we talk about tariffs, we talk about geopolitical tensions, but then there's a fundamental issue about what your product market is.
Okay, so I have a different niche of customers. I'm North America director, so I have customers in Canada, the US, and Mexico. So they have different, different specificities. But let's try to focus my US customers. Again, we have foundries, we have steel mills, and we have battery material producers. Talking specifically, and aluminum companies, talking specifically about the battery material producers, they are scared. They were scared about Chinese competitions. They are scared about this volatility. Every day they have new rules. They have, a few years ago, they have incentives for EVs. They have incentives for energy storage systems. The country invests a lot of money in wind and solar generations. Obviously, we all know those kind of energies, those kind of alternatives. They need energy systems because we don't have sun and wind all the time. So they have to. It's necessary to have energy storage systems. So they have that possibility. But at the same way, they have a very volatile environment that changes, the rules change all the time, and they're struggling to do that. They don't have, they put their hand down and try to keep walking, but they are very concerned about if they will be able to compete with the giga Chinese factories. They're very efficient, low cost. It's not only about the cost, but it's about the technology. The guys have been working on that for a while. It's not easy to compete, and all those uncertainties make their job even more difficult.
So a very challenging environment. We're almost out of time here, but I think there's probably a moment for some questions from the floor, if there are any. Okay. Well, we are effectively out of time, unfortunately. We could probably go on discussing this for quite some time. I'd like to thank Haroldo, Daniele, Lance. Please, could you give them a big hand?